The markets are currently closed. The following analysis reflects the most recent trading session data from Friday, November 21, 2025. Opendoor Technologies, Inc., ticker Open Capital Open, closed the last trading session at $6.75, registering a significant intraday surge of 59 cents, or plus 9.58%. The stock displayed immense volatility throughout the session, oscillating between a low of $6.23 and a high of $7.03, with a massive volume of approximately 160 million shares changing hands, far exceeding its average daily volume. After-hours trading saw a slight consolidation, with the price settling near $6.73. The narrative surrounding Opendoor is one of the most polarizing and intellectually demanding puzzles in the current market landscape. If you look at the surface-level chatter on retail forums or the headlines on your Robinhood app, the expectation is that Opendoor is merely a house flipper trapped in a high-interest rate environment, a relic of the easy money days of 2021 that is slowly bleeding out as mortgage rates remain elevated. That is the expectation, a zombie company walking toward inevitable irrelevance. The reality, however, is far more complex, far more dangerous, and potentially far more lucrative. The reality is that Opendoor is currently executing one of the most aggressive financial and operational pivots we have seen in the mid-cap space this decade. We are not just looking at a real estate company, we are looking at an entity that is attempting to transition from a capital-intensive asset holder into an AI-driven commerce engine for residential real estate, led by a leadership team deeply connected to the e-commerce philosophy of Shopify. The massive 9.6% move we witnessed on Friday wasn't just random noise. It was a reaction to a convergence of macroeconomic shifts and a highly specific, complex corporate action regarding warrant distributions that many casual observers completely missed. While the crowd discusses flipping houses, the smart money is analyzing a shareholder-first capital restructuring and a bet on the liquidity of the profound U.S. housing asset class. When you open your Fidelity mobile app or log into your Interactive Brokers account to look at a chart of Opendoor, you are seeing a visual representation of pure uncertainty battling against extreme conviction. The stock is up over 300% year-to-date as of late 2025, yet it remains roughly 80% below its all-time highs. This disconnect creates the tension we need to examine. The market expects Opendoor to fail because Zillow failed at iBuying. Zillow, a tech giant, looked at the unit economics of buying homes at scale, realized the algorithmic risk was too high, and exited the arena. The market therefore assumes Opendoor must follow suit. But the reality is that by being the last man standing, Opendoor has absorbed the entire market share of instant liquidity for home sellers. If, and this is the colossal if that defines the trade, they can automate the pricing engine to remove human error, they become the Amazon of real estate. If they fail, the equity is worth zero. There is almost no middle ground here, and that binary outcome is what attracts a very specific type of capital. Let's dissect the recent price action from Friday. The surge to $6.75 was driven largely by comments from New York Fed President Williams, who signaled that further rate adjustments were likely in the near term. For Apple stock or Microsoft, a rate cut is nice. For Opendoor, it is oxygen. The company's entire business model relies on the spread, the difference between the price they buy a home for and the price they sell it for, minus carrying costs. High interest rates increase those carrying costs significantly. When the Fed signals a cut, the market immediately reprices Opendoor's debt burden and the potential velocity of the housing market. But there is a second layer to Friday's movement that you won't find on a standard SoFi investing dashboard. On November 21, Opendoor executed a distribution of tradable warrants, tickers OpenW, OpenL, and OpenZ, to existing shareholders. This is a rare and somewhat exotic move for a tech company. Essentially, management handed shareholders leverage, options to buy stock at specific prices in the future. This creates a complex arbitrage dynamic. Hedge funds and high-frequency traders often scramble to adjust their exposure when these types of derivatives hit the market, leading to the massive volume spike we saw: 160 million shares traded in a single day. This wasn't just retail investors buying the dip. This was institutional plumbing recalibrating around a new capital structure. It is crucial to understand the lock-in effect that has paralyzed the housing market for the last 3 years and how it plays into Opendoor's hand. Millions of Americans are sitting on mortgages with rates below 4%. They refuse to sell because moving would mean swapping a 3% mortgage for a 6 or 7% one. This has decimated inventory levels. The expectation is that this hurts Opendoor because there are fewer transactions. The reality is that this lack of liquidity makes Opendoor's value proposition stronger for the few who must sell. If you need to move for a job, a divorce, or a death in the family, you cannot wait 6 months for a buyer in a frozen market. You need liquidity now. Opendoor charges a premium for that liquidity. In a frozen market, the provider of instant liquidity becomes the kingmaker. Now, consider the operational shift. Under CEO Kaz Nejatian, who previously served as COO at Shopify, the company is stripping away the bloated operational costs of the past. They are moving away from having thousands of human estimators and towards a centralized AI-driven pricing model. This is the Shopification of real estate. The goal is to make selling a home as easy as setting up an e-commerce storefront. This is where the Tesla stock comparison comes in, not in terms of product, but in manufacturing efficiency. Tesla won because it figured out how to build the machine that builds the machine. Opendoor is trying to build the machine that prices the machine. If their algorithm can accurately predict the sale price of a home in Phoenix, Arizona, 3 months from now, with a variance of less than 1%, the business prints cash. If the variance is 5%, they lose millions. This brings us to the exclusives and marketplace products. Investors using Schwab Intelligent Portfolios or seeking investment help often look for diversification. Opendoor is diversifying away from using its own balance sheet. In the past, they bought every house. Now, with List with Opendoor, they're acting more like a traditional agent, but with a tech twist, helping you list the home while keeping a cash offer in your back pocket as a backup. This is brilliant because it captures the customer early in the funnel without risking Opendoor's capital. They are effectively becoming a Zillow competitor, but with the nuclear option of actually buying the house if the market fails the seller. We also have to consider the institutional flows. When you look at data from Fidelity Investments or Fidelity Wealth Management reports, you see a tug of war. Some institutions have completely exited, citing the interest rate risk. Others, like Vanguard and certain quant funds, have increased their stakes. Why? Because the risk-reward ratio is asymmetric. If Opendoor survives this cycle and rates normalize to the 4 to 5% range, the stock does not just go up 20%, it could theoretically return to its IPO valuations, which were significantly higher. It is a venture capital-style bet available in the public markets. However, we need to ground this in the cold, hard numbers of the Q3 earnings report released earlier this month. The company reported revenue of $915 million, which actually beat expectations, but they still posted a net loss of $90 million. They are burning cash, though significantly less than before. The contribution margin, the profit they make on each house before corporate overhead, is the number you must watch. It has been volatile. In some quarters, it's positive. In others, when prices suddenly drop, it turns negative. This is why the stock is not for the faint of heart or for a conservative Fidelity Iris account designed for stability. This is a high beta, high octane instrument. Let's pause for a moment and look at the broader ecosystem of online investing. Whether you are using Robinhood Crypto, SoFi Active Investing, or a traditional individual brokerage, the psychology of trading a stock like Open is distinct. It attracts event-driven investors. These are people betting on specific catalysts, a rate cut, a technological breakthrough in their pricing model, or a bankruptcy. The tension here is palpable. Every data point on existing home sales released by the National Association of Realtors sends this stock moving 5% or 10% in minutes. Comment below how many shares of Opendoor you currently hold, or if you think the iBuying model is fundamentally broken. Continuing with the analysis, we need to talk about the Agent Partner Program.